Hello, everyone. We'll get the meeting started. For attendance, got me. I see John Burbank is on, Michael Freeman. We have Mark Ofinger here. Am I missing anyone online? That's a member of the committee. Okay, I believe that's it. To make it easier for, you may have overheard our nation, but to make it easier for minutes, if you make a motion, please state your last name as you do it. For a second, so that it's easier to do the minutes later on. I'll meet order at 2 p.m. Any board communications? Okay. Finance director report.
Everyone today. Great. Okay, so for the quarter ending March 31st, 2023, there was an increase in revenues of approximately 1.1 million. This was mainly attributed to the employee contributions that occurred during January, February, and March, along with an increase in the dividend income, 23,000. We have seen an increase in rates at the various banks, so that's a positive sign. There was a slight increase in the realized gain of approximately 30. I'll get that number in a second. There was also an increase in the realized. As far as the expenditure side goes, we are at approximately 8.3 million, or an increase of 2.75 million from last quarter, and 2.7 million of this is related to the pension payout. And let's see, it also includes the second half of the admin fees for SEI and SageView, and that was that. There weren't a lot of return of contributions paid out during this quarter, which was nice to see. Not as many bodies leaving the town. So that was positive. Are there any questions?
Yeah. Okay, moving on to the approval of the February 9th, 2023 meeting minutes. If you've had a chance to review, I would entertain a motion.
So moved. Offinger.
Motion by Ofinger. Do I have a second?
Freeman, second.
Second by Freeman. Any discussion? Any changes? If not, all in favor, say aye.
Aye.
Opposed, say nay. Okay, motion passes unanimously. On to the authorization of payments from retirement fund for retirement benefits. We have about 7, it looks like. And again, if we do these in one motion, then I would entertain a motion on that.
So move, Michael Freeman.
Moved by Michael Freeman. Do we have a second?
I'll second it. This is Offinger, but I think we had it corrected.
Oh, we had one. Yeah, I think it's listed here on this page.
Yeah, it was I think it was just for.
Yeah, Leland Rummel.
Yeah.
Yeah, so that has been exchanged now. Wish we did. Okay, any discussion? All in favor, say aye.
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 All opposed, same sign. Motion carries. SEI Investments, we have a special guest. You want to introduce yourself and?
Sure. Yeah, a little last minute change again. I apologize that Pat couldn't make it. He has a bug and did not had an unfortunate night, so he asked me to step in for him. Daniel Cappell, also a client portfolio manager at SEI, work with a variety of different plans, primarily in the public and multi-employer space. So I did get the Coles notes from Pat, and look forward to running through today's materials with you.
Excellent, thank you. Go ahead.
And I believe there was a couple of items from SEI's end, the first one being the investment policy statement and then the regular quarterly update. So just for ease, probably makes sense to go through the investment policy statement to kick things off.
We had a schedule later, we can move it up, if that makes sense, go ahead.
Oh. Sorry, that's no, there's no, that's
Makes sense for you to do it first, we can do that.
okay. Was it going to be my segment here anyways, or was there? Okay,
Yeah.
great. I will. Do you want me to share the most recent draft, or is everyone have a copy?
Everyone should have a copy was sent out.
I think what was sent out, John, was June 2019 one.
Oh, okay, Ron, okay.
I think
You would have-
that's.
Oh, okay.
Or it
So,
Okay.
23 then, is that right?
was gonna be.
Okay, does everyone, do the members online?
This is the one that was sent out in a separate.
Okay.
Well, I'm sorry, June 2019. Unless it was something sent out earlier. I just
People online, have you seen the June 23 copy?
We do. SageView has received it and reviewed it.
Yes, I have a copy.
Okay, let's proceed then. We all have.
Okay, fantastic. And I know ultimately what we're trying to accomplish here is to simplify the document and reduce the need for constant revisions if there is an asset allocation change, and just clean up some of the exhibits as well as some of the return targets and expectations. Unfortunately, as its initial form, it was a PDF document, so I know that Pat did have to retype everything out for the most part, so there is not a red line version. But I will focus in on the core pieces that were updated. This is really just a starting point, and of course, any comments to working document. So please do let Pat know based on your feedback from today. So I will just quickly scroll down to the portion on where is it here? Performance measurement standards in section 6.
It's page 7,
Page 7.
section 6, page 7.
Yes, exactly. Thank you. So I know that there was a number of typically the exhibits are not often would be included in an investment policy statement. So all references to the exhibits were removed, and you can see that all of the exhibits were removed as well. That was, one of the, I would say, the largest change. It's great to have those as a point of reference for discussions when speaking to an investment portfolio, such as the efficient frontier, looking at returns relative to inflation. But overall, it was of our view to remove those exhibits as it's not typically found in an investment policy statement. So that was one of the major changes. As well, I apologize, I'm going back and forth between the old document and the new document. There is reference to real return objectives. I'm going to be jumping back up here. That is section 3, general policies.
Page 3.
Yes, page 3 starts on page 3, but we're going to be looking at section or item C. And with here, it was changing the language, typically of return expectations of the overall portfolio. I believe that the market cycle should be updated to 10 years, as 5 years is a very condensed time frame. So I know that was one thing that Pat had highlighted. As we can see, well, I mean, COVID, a market cycle almost happened in the span of 18 months. But traditionally, a real true market cycle for looking at and evaluating is typically 10 years. I mean, if we look at a great example is, the run up of tech stocks of 2010 to 2020. I mean, they're getting some life now. The 2000s was all about emerging market expansion. Then you had Japanese expansion, energy companies. So really, things tend to happen in 10 years. 5 years is a very short time frame to really see a true trend. So that was removed. Another item that was removed is there's the 7.25% nominal. I believe that was changed to 6.75% nominal for the assumption rates. And it's fine to leave that in there. That is not something that's going to be changing frequently, of course, based on market cycles and where we're at and how we see things on a forward-looking basis. But that's something that should typically not change on a year-to-year basis, more of a longer term along with market cycles. And for the asset allocation, really cleaning that up to focus on what the asset in section E, that is looking at what the strategies are and really simplifying it. Again, sometimes in older investment policy statements, you'll see specific asset classes. You're really just tying your hands, and you'll often have to revisit anytime an asset allocation is shifted and you have to go and open up the document again. By having these broad ranges, it gives you some flexibility to not have to, to edit the document on an ongoing basis. Of course, in the investment management agreement, you would have the stated asset allocation as well that the investment managers are going to adhere to. And the overall advice study driving those ranges. So it just gives you flexibility to operate within a range without having to open the document back up once again.
Yeah, 1 second, please. Jason Pollard has shown up. I'm promoting you, Jason. And you can go ahead again.
Sure, thank you. And then one of the other is the return expectations. Sorry if I'm hopping around, that's moving up to C. I apologize, I'm trying to do my best without the red line version. I just have the two side by side. The return expectations, again, removing the language around a real rate of return. 500 basis points plus CPI is a very aggressive target, particularly in the environment we're in. So it's more so to have an absolute. Of course, you're going to take inflation into account. Inflation can be volatile, particularly if you look at CPI plus right now, you'd be looking at on an annual basis, something closer to 10% or so, which is not a reasonable target. And you're not going to want to have to extend yourself from a risk basis just to adhere to lofty inflation targets. So it's of course, inflation is something you want to consider, but we find a CPI plus is not necessarily the most efficient way of looking at it, unless it's going to be CPI plus 1 or 2, but then you're confining yourself going in the other direction as well. So not something necessarily to be put into an IPS. And then taking out the fund benchmarks as well. Of course, managers have policies in place to have an appropriate benchmark, and similar to how when the asset allocation changed, your benchmark's going to change, and you're not going to want to have to open the document back up to make those changes. So really, overall, these changes are meant to have to create a document that does not have to be opened up, reviewed in depth, constantly based on underlying prevailing market conditions, as well as any changes that are made in the portfolio as a result in those changes throughout the cycle. So it's just to tighten it up. And that really, this is a governing document for the fund. So you want it to be easy to adhere to and not have more items that, could potentially be in violation or that you're not adhering to in the process. So you want it, of course, to be there for a strong governance structure, but within reason and not having to open it up too often. So those were the major changes that looking at side by side that I could see. Again, Pat mentioned this meant to be a working version of it. I know that all of the legal language for in relation to Connecticut and the laws, they were not, that language was not touched at all, but it was really just meant to simplify things that can change on a frequent basis. And then of course, removing the references and the exhibits.
Mark, you said you had a chance to review.
Yeah, we had a planning meeting with Pat about a week ago and kind of walked through some of these things. So we like the revised version, kind of agree with Daniel. It's it's simplified. It's a little bit more flexible. It should cause for less. It should be a little bit require less revisions as market conditions change, or we might be a little flexible with changing funds, those types of things. So we were comfortable with it. We think it makes sense to kind of work off of SEI's template, since they're the ones, managing it. We always think that's best practice. When we act as the investment manager, we tend to use our template, and that way it matches what we're actually looking at when we have these meetings, and it kind of ties into the reporting nicely. So no additional edits from the clean copy you got a couple days ago, or the end of last week.
Thank you. Any member comments, questions?
I'm assuming you'll have legal review of it before we re-execute it, I'm assuming, correct?
Sorry, I couldn't hear part of what you said.
Will you have legal review this before we, yeah, that would have been our recommendation as well. Just again, going back to any Connecticut state law, anything else that would need to maybe be updated there. But from an investment standpoint, we're very comfortable with it.
Okay, we'll get it. Bring it back next time.
Yeah, and again, if there's any other, it's all, I can let Pat know that it sounds like there's comfort. And if there is any feedback from legal, of course, this is your governing document at the end of the day. So ultimately, you need to be comfortable with it. You know, the investment managers typically are relied on to provide information and give you the guidelines. But ultimately, it's the representatives of the town whose signature is going on the dotted line, affirming the information in the document.
Board members, any feedback on whether you're okay with the changes? Pending attorney review?
I have no concerns about the changes that were just discussed.
Yeah, same here, Jason. I have no concerns.
I'm not sure I have any concerns at this point, though generally I like to see more documents as less. I don't believe, it's probably a good idea, I don't believe we've ever had a town attorney. It's something that they put together, take us through the various changes and updates and so forth. I certainly, and so I'm not sure who at the town attorney's office. Chances are they don't have any background back to it.
And if I may add, what you can often do is if there was anything that is constraining or that you wanted to at least have reference to, you can put an appendix. Sometimes what you'll see, that way it's not in the actual document itself and it's more flexible dealing with that. You don't often see that. It's typically attorneys that drive that, having an appendix added in, but I think this one is pretty all encompassing. As it's fairly standard from what you see out there. You know, I've worked with organizations that have a 12-page IPS that is overly cumbersome, and if the amounts of compliance that goes through, it's the full-time job essentially for someone to adhere to it, which you don't want to have the burden of, as well as the risk of having a document as the governing document for the plan.
So John, one of my comments is somebody may have to sit down with whoever the town attorney is.
Right. They have to
Give them
reach
a
out
little
and
bit
get
of
some here.
background.
What's it, I'm comfortable saying it to the town attorneys, but what's the feeling of the board members? Would you like to send it to the attorneys and we'll bring it back next time?
That's fine with me. I think if they're suggesting we send it to
So somebody might hear from one of our attorneys. We'll hook you up if that's the
invite them to
case.
the next meeting.
Yeah.
I'm fine hearing from attorneys as long as it's about investment policy statements.
Okay, great, thank you. On to the regular report then?
Yep, sure. So let me pull it up here. And again, does everyone have a copy of the report, or did you need me to?
We all have a copy.
Okay, perfect.
So it'd be good if you call up the page number.
Sure, I will do just that. Sorry, I'm just pulling it up here. Okay, great. So I will start off on page 3 with the executive summary. As we can see, Q1 was obviously a nice breath of fresh air after the tumult of the prior year, and kind of a continuation of some solid returns that we saw coming out of December with a little bit of hiccups along the way. So the plan did finish with a Q1 2023 return of just over 5%, bringing the 1-year return to -6%, 3-year return close to 10, and the longer term return at the 5-year return at 6.11%. It's, we're obviously in a very interesting environment right now. Getting just over 5% in a quarter is great, but there is a lot of overhanging uncertainty, particularly where the Fed is going to go, what's going to happen with the debt ceiling, and the Fed has been trying to engineer a recession or a slowdown of the economy, and it's how have they done with that job, and have they done too much? So we have seen that that inflation has been slowing a bit, and it would be expected that with the credit tightening, based on what's going on with regional banks right now, they're going to want to shore up balance sheets, and lending will slow down, which should slow down the economy. So we have seen improving inflation numbers. It will be very ironic if inflation was in fact transitory, but since no one defined what the word transitory meant and what a time frame around it was, it could end up correcting. And I think the Fed is in a difficult spot where they don't want inflation to resurge. They don't want to have a too much of a slowdown. So they're kind of trying to walk this tightrope of keeping inflation under control while not over tightening. And then, of course, as I mentioned, the overhang of the debt ceiling. So we did actually see that they did tighten again at the most recent meeting. As of when I most recently looked, based on the implied odds, this is calculated through the futures market, is about a 20% chance of another hike in June. But with what's going on in regional banks, I think that's why that probability has maintained at a bit of a lower probability. It would really take some high inflation numbers or the job market not trending in the right direction to change that. And inflation came right in line with expectations yesterday. It is still heading down, and employment has been softening slightly. I'll pause there for any questions on the executive summary. Okay, great. So now moving over to slide, sorry, I'm working off of one monitor right now, slide 5. The market performance overview. So as you can see on the right-hand side of this page, that whatever was deeply negative last year is for the most part now positive. It was really, as I mentioned at the top of the presentation, a reversal. Particularly bright spots were world equity ex-US and US large cap. A lot of that had to do with, as there was concerns within the banking sector, lower rates meant for weakening US dollar, which it's beneficial for global equities, and then a lot of the mega cap tech stocks have really taken off. And another thing that we've seen from an inflation standpoint, if you look at commodities, negative over a 1-year standpoint. Think of last year and heading into the winter, really, there was all these concerns, people heating their homes and these exorbitant energy costs, and a lot of that concern has now settled for now. So it's been positive overall, and we had unseasonably warm winters throughout the globe. Taking a look at the US equity markets on slide 6, just wanted to bring your attention to the left-hand side, bottom left-hand side. So what we did see was a reversal again of the trend, as value had been outperforming growth throughout last year. And that reversed in a large way in the first quarter as a lot of these technology companies rebounded. The reason I speak to that is in the active management strategies, this is going to have an impact. SEI and typically active managers overall are going to favor value as opposed to growth. So that means paying less for $1 of earnings, less for $1 of sales, or less for an enterprise value or book value of a company. So when I get to the performance section, you'll see that the active strategies underperform slightly. Taking a look at the international equity market review, one trend that is starting that has not been around for the past 12 years is that developed markets, ex-US, international markets have started outperforming the US. And that is not something that we really, since coming out of the global financial crisis, this isn't something we've seen. So it really stresses the importance of having that international diversification. And as I mentioned, with market cycles of 10 years or so, it kind of goes in waves. And if you look historically, you'll have 5 5, 7, 10 years where international markets will outperform and then US markets will outperform, and you kind of see these shifts between the two. So it's important to have that international diversification to reduce risk. And it can be painful while it's going on, but you never know when these trends are going to reverse. And then finally, taking a look at the fixed income, that's on page 8. So what you can see here, again, looking at the bottom left-hand side, is that due to the Fed's tightening, that's what influences the shorter end of the yield curve. You can see that short end rates are much higher than the longer end rates. That means that there is an expectation for the Fed to reverse course in the near term, and as well as inflation expectations are in check, or a recession is that what's telling you the inverted yield curve. But you can see from 3/31/2022, which is the bottom line, the shift up to 3/31/2023. That move is really what caused all the pain in fixed income markets, and why we saw all those negative returns across fixed income portfolios throughout the past year. But now, it's great. It's a great time to be a saver, and clip higher coupons, and bonds are yielding much higher percentages. You're able to purchase them at a discount. And then on slide 9, just an interesting graph on demographics. As we see, there are broad demographic shifts going on, and low fertility rates. And what we saw was, China was really the global workforce, and that was one of the things that kept inflation low. And there's a lot of talk over now of operations for geopolitical and other security concerns, but India is starting to pick up as a desirable place, as we saw Apple is now making a push into India, seeing as the next big emerging market economy. Another interesting trend is Mexico. With nearshoring, a lot of U.S. companies are starting to open up their factories in Mexico and bring those supply chains closer to home, influenced by the pandemic, number one, and number two, as we saw. Foreign adversaries may not be the best place to have your production, as we saw with Russia, and relying on them really for energy, but now China with their labor. So interesting trends overall from a demographic standpoint. I'll skip over slide 10 and just move to the performance report. That is on slide 14. So taking a look at the quarterly return, it was just ahead of the benchmark on a net basis by 7 basis points. So really everything did well, as you can see, across the equity sectors. Just wanted to bring your attention to, as I mentioned, that value did struggle relative to growth. As you can see, the US equity factor allocation fund did struggle against the broader based index. It is, value still has a long way to go relative to growth. We still think valuations are pretty stretched in a lot of these names, and it is, it's like turning a tanker. It takes some time for these trends to unfold. And looking down to the longer term, as I mentioned, a lot of these, you still have great returns across the equity portfolio. Equities are up 18% over 3 years, 5% over 8.5 over 5 years, 10 over 7, and close to 10 over the 10-year period. So still very strong equity returns. And taking a look at fixed income and what we should see changing going forward after there's been this pain with yields going up. Over the longer term, 10-year returns on fixed income has been, on the fixed income side of the portfolio, around 2%. If we look at what yields are, where they're at right now, really across the board, and it's closer, you get a 10-year at around 3.3% right now. So there is some opportunities in fixed income to generate higher returns. So we have seen a bit of a reversal there. And I will point out that as the US dollar softened in the first quarter, you see, for example, that the emerging markets debt fund did quite well, as it has exposure to some of those emerging market currencies. I will point out that the emerging market debt fund is meant to be a return enhancing portion of the portfolio. And when markets are going risk on, typically means the US dollar is softening. So you get a bit of additional diversification from the currency within that portfolio. That concludes my remarks on the performance. I'm happy to dive into any of the specifics of any of the funds. Again, solid quarter. I think the the damage that was done in fixed income last year would be hard to replicate, but definitely some uncertainties looking forward in the equity markets and somewhat in the fixed income market based on the US debt ceiling and the inflation picture.
Questions? Okay, appreciate it. Thank you.
Great. Well, thank you very much. I appreciate you giving me the time. And again, apologies on Pat's behalf. I'm sure he's curled up in bed right now with some sort of chicken noodle soup or something to make himself feel better.
You're a very capable replacement. Appreciate it. That's a SageView.
Excellent, thank you. So I'm going to probably hit 6 or 7 pages from my deck. Don't want to be repetitive, but on page 6, just, for what it's worth, I think a very similar economic outlook and a similar outlook of the risks and uncertainties that we're facing. So this is just our committee's economic scoreboard, kind of the good, bad, and the ugly. Strong employment, decent consumer spending, kind of keeping us out of that recession, at least temporarily. All eyes on the Fed. We think the Fed is done raising rates for now. And the bigger issue is, when will they start to cut rates? The market seems to think it's going to happen sooner than Powell does. So we'll see where that kind of plays out. Debt ceiling, probably the biggest issue we face now in the short term. I think there's a hope or a belief that there'll be a settlement, but we'll see. It's lining up to be a pretty big political fight. And still kind of dealing with some of the negatives, post-COVID slowdown in manufacturing, trade tensions, weakening corporate earnings, and fiscal spending. So yeah, I think the outlook's very cloudy for equities, at least in the next few quarters. Fixed income, again, assuming the debt ceiling, there's a compromise. The outlook for fixed income looks pretty good, as yields on most of these portfolios are strong, 4, 5, 6%, and the prospect of interest rate cuts, at least within the next 12 months, should bode well for fixed income. So very similar outlook from SageView. Going to have you move to page 28. So as Dan mentioned, from a portfolio level, the portfolio has generally exceeded benchmarks, which is great, strong performance. What we do at SageView in our role is to look at the underlying funds from a quality standpoint. We apply a SageView ranking, which ranges from 1 being the best, 100 being the worst. The average score for the funds in your plan score in the 22nd percentile. So on average, they're beating 78% of their respective peers. Page 29, this gives a breakdown of the actively managed funds in the plan. So again, we take those 9 criteria from left to right. We look at each fund versus their competition or peer group, and we rank their performance with those 9 criteria. Again, lower is better. And then to the far right, you'll see the overall SageView normalized score. So if we were to look at the first one, the limited duration bond, the overall score is a 27. That means it's outperformed 73% of its competition based on our criteria. And generally gets good to average scores for all 9 criteria. Core fixed income, high yield bond score in the top decile, really exhibited outstanding performance over the long term. The emerging markets, you'll see kind of a mediocre score that's in the 57th percentile. It's a little bit of a tough category. It's a smaller category. So you're going to see a good 6 months or a bad 6 months could really move your ranking, since it's a smaller subset than the other funds in the plan. This is a new fund added a little bit less than a year ago. And since it's been added, it's performed well. So as Daniel mentioned, we've got some good diversification benefits, and it's performed well versus its peer group as well. So while it's been in the plan, it's performed very well. factor allocation in the 41st percentile. And the real estate fund continues to be a strong performer in the 14th percentile. So we have nothing, from time to time, we'll have things on our watch list where we see, continued underperformance, not short underperformance, but longer underperformance. At this point, we don't have any of these funds on our watch list. We're comfortable with each one of those. And then a decent part of the portfolio is indexed. So on page 30, you'll see the listing of the index funds that we use, or the SEI uses. We look at this a little bit more simplistic. It really comes down to cost and how well the fund tracks its index, and any risk-adjusted statistics. So all the funds, our index funds, are scoring well and passing our criteria. I will point out on 33, just to my comments on the emerging market debt funds, about the middle of the page. It's about a 3% holding. You'll take a look at the short-term performance, which really applies to this plan. Really some good outperformance in the first quarter, 376 versus 186. And over the last year, even though it's down, it provided some good down capture protection. And that covers the length that it's been in this plan. So nothing from our perspective that worries us. That's on an internal watch list. Comfortable with the allocation. We like kind of the healthy allocation to international, as we agree with Daniel. Seems to be some better opportunities, lower cost, better valuations overseas than in the U.S. So I think it's about 18% allocation or so to international stocks. That's all I had for prepared comments. Any questions for us?
Questions?
So Mark, just what's the ability to kind of look at other funds that we're not in and do some hypothetical, if we had money in whatever fund, this is how the performance. Maybe I'm just misunderstanding what's been presented and talked about, but why do we stay in emerging market debt when it's in the 57th percentile?
Well, we just recently added that. SEI recently added that fund last year, just for a little bit more diversification.
Okay, so when we look at historical rankings, that isn't page 31. That is, it goes back to June of 2020. We didn't have it back then?
Correct. Yeah, I can, Daniel, I don't know if you have the date that you put it into the portfolio. I don't have it handy, but I know it was calendar year 2022.
That's okay. That's fine. I'm trying to understand the capability of being able to do some what ifs. If we decided a couple of years ago not to go into emerging markets, but went into something else, where would we be? And I'm not looking for on-the-spot responses to that. And it may not be possible. I have no idea.
Yeah, and it's a great. Sorry, Mark, if I can jump in here on that.
Sure.
So it looks like it was it's less than a year based on the. I don't have the exact date, but you can see there's not a 1-year return number. So it was sometime in the last year that this decision was made. We find again that it's a return enhancing part of the portfolio. So you're trying to get diversification, low correlation with other asset classes, what you're trying to look for. Obviously, it was a difficult time because the US dollar did go on an absolute tear over the past year, which has since started softening, really starting in late October of last year. So probably it's a very short time frame to be looking at that, but you have different yield environments across different countries. And some emerging markets, if you're looking at, you look at many factors of credit quality, the financial stability of those countries, and you can get some pretty attractive yields. That's why we don't lump it in with our fixed income, because you're trying to generate similar to high yield. You're using it to as a risk-taking part of the portfolio. So it does give you some diversification benefit in that sense. It probably falls more in line with looking at something along the lines of high yield. And I know if you look at the category, I believe some of them are all do not have that currency exposure, Mark. It's the category kind of combines them both. So in
Right.
times where, I mean, currency has been extremely volatile over the past year, it can, over the long term, that tends to work itself out. And that's why you're kind of seeing this result where we stand right now.
To your question, though, I mean, part of the reason, part of the role we play is to monitor the fund. So, for instance, it's not the case, but if the core fixed income fund, if it starts to show up in our third quartile for a few consecutive quarters, then yes, that would be the role, would be to look for a replacement that's performing better. So that's why we go through this monitoring process. To your point, though, you see that third quartile score. I think Daniel did a good job explaining, a little bit unique with the currency exposure, smaller subset of funds, so it's going to be a little bit more volatile as far as the rankings. And we've been monitoring that performance only for the last year since it's been in the portfolio, where it's really shown a lot of outperformance, and we think added some good diversification to U.S. fixed income. But there is the ability to swap out funds, to look for alternatives if something's not performing well over few consecutive quarters.
Any other questions? Yeah, thank you. Interest rate on employee contributions. This is just something we have to, is that?
I'm gonna read it.
You just say what it is, quick.
Okay.
Let me find it in the back first. Awesome. Oh, you didn't accept it. Okay, yeah, go ahead and read it.
Okay, so this is the interest rate on employee contributions. Informational item only. In February 1994, the retirement board adopted a policy whereby they tax rate on an employee's return contribution, i.e. those employees who terminate employment with the town and take their retirement contributions with them. The policy sets the interest rate at 120% of the federal midterm interest rate, with the caveat that the applied rate can never be more than what the retirement. The 120% of the federal midterm rate is the mandatory rate that the Retirement Income Security Act, the private sector, applied to. The rate will be applied to employee contributions on account as of June 30, 2022. The 120% of the midterm rate published as of July 1, 2022 is 3.59%. And the retirement fund's rate of return on market value was a loss of 12.74% for the fiscal year ending. Therefore, in complying with the board's policy, a rate of 0% will be applied to those employee contributions held as of June 30, 2020. Recommended action is that the board accept and file this information.
Thank you. Have any questions for Dee? If not, I'd entertain a motion to accept the report.
So move. This is Offenberg.
Looking for a second?
Second, Jason.
Thank you. Any further discussion? All in favor, say aye. Aye.
Aye.
Opposed, same sign.
And it may be helpful in the future, if the information is available, that if this memo gets issued, that we attach kind of a table showing what it's been over the last 10 or 15 years. If that,
Sure, no, absolutely.
I don't think it would help folks to understand how it works.
I did have to go back a ways to see when that situation occurred where it was applied.
Yeah.
That it occurred, it didn't happen very often.
Yeah. Okay. We made two is caught this time, did we? Next meeting will be on August 10th. If you have any conflict with that, let us know sooner rather than later, please. Would entertain a motion to adjourn.
Michael Freeman, so moved.
Jason Pollard, second.
Freeman for the motion and O'Hare for the second. All in favor, say aye.
I
Aye.
Aye.
Okay, thank you, everyone. Have a good day.
Thank you.
Bye,
Thank you.
Dave.
You too. Bye now.